Welcome to today's webinar, The Changing Transaction Tax Landscape in Canada, What Businesses Need to Know. My name is Jane Van Son, Marketing Manager here at TaxWare, and your MC for today's webinar. First, review a few housekeeping items. This is one of complimentary webinars that TaxWare offers to tax, finance, and IT professionals during the year. The webinar lasts for 60 minutes, including a Q&A segment, and will end at 1 p.m. Eastern Time. I'd like to mention that today's webinar is being recorded, and you are currently in listen-only mode. As the last 10 minutes of today's program have been reserved for Q&A, in order to ask a question, type your question at any time during the webinar into the Q&A panel, which is located in the lower right-hand corner of your screen. Then click on the send button to enter your question into the queue, and we'll do our best to answer all the questions. Go to PDF of today's slides. Please go to the upper left-hand corner of your screen and click on File. Then from the drop-down, select Transfer. The pop-up window will then appear on your screen, and you can select the file and click on the Download button. During the presentation, we will ask for your feedback via a few polling questions, which appear on the right-hand side of your screen once the poll has been opened. Click on the radio button that corresponds to your answer to place your vote. CP certificates will be emailed to those who qualify within 30 days of today's broadcast. We will have a brief survey at the conclusion of today's webinar. Please remember to qualify for CPE credit. You are required to complete the survey as well as all the polling questions. And if during the webinar you are experiencing an issue, please enter it into the Q&A panel and our producer will respond. And a good segue to our next slide. We'd like to ask who is requesting CPE credit. Okay, thank you. To introduce our speakers, I'd like to provide some key information about TaxWare. Recently, ADP divested its transaction tax business, and we're excited to be back presenting today as TaxWare. TaxWare is a leading provider of automated transaction tax solutions with more than 3 decades of experience and innovation in the sales, use, and value-added tax compliance arena, providing an industry-leading suite of end-to-end sales and use tax solutions with both hosted and premise-based deployments. TaxWare developed highly comprehensive proprietary tax content that incorporates the ever-changing complex rules in the U.S. and over 250 international jurisdictions. Lastly, TaxWare was also the first vendor in the market certified by the Streamland Sales Tax Governing Board with certified solutions for both hosted and on-premise use. And I'd like to introduce the panel of speakers for today. Charles Maniaci is the Director of Tax Research at TaxWare. He leads a team of attorneys and other tax professionals responsible for all tax content that is incorporated into the TaxWare calculation engines. He worked at TaxWare for 10 years, and he is an attorney and a member of the Massachusetts Bar. Howard is a Senior Tax Council member in the Tax Research Department at TaxWare. She's responsible for researching transaction tax laws in the U.S., Canada, and other countries, including those within the EU. TaxWare since May 2003 and has over 20 years of transaction tax experience, including experience in the public sector as a sales and use tax auditor for the City of Boulder, Colorado, and as a consultant in the state and local tax group at Ernst & Young. She's both the Massachusetts and New Jersey Bar. Eugene, Senior Tax Counsel, has been with TaxWare Research Department at TaxWare since April 2008. Eugene's research focuses on sales and use tax in a number of U.S. states, GT, HST, PST, and other point-of-sale levies in Canada and VAT in China, as well as other countries. She has a cum laude from Boston University School of Law, an MA from Syracuse University, and a BA from Nanjing University in China. Nelson is a Senior Support Engineer. He has a variety of roles during his 23-year tenure at TaxWare. Currently, he is primarily responsible for the support of the sales use tax system. Now I'd like to turn the program over to Chuck to review our agenda for today's webinar. Chuck?
Thanks so much, Jane. So I'm pleased to be presenting with my esteemed colleagues, both in research and in support. It seems that this strikes me as a kind of a familiar group, and I think that's because we all met about 2 weeks ago to present a webinar talking about British Columbia and Ontario harmonization. So here we are just a few years later, presenting another webinar, this time about harmonization and deharmonization. So in terms of the agenda, really what we're going to try to do is present an overview of how taxation works in Canada at the federal and the provincial level, sort of to level set everybody's understanding about what's happening in Canada. From there, talk about how Canada is supported in our calculation engines, and then talk about what's going to change effective April 1st, 2013, and how those changes will impact the use of our system. Into the presentation, we're a little time talking about point-of-sale levies other than taxes at the provincial level in Canada. The reason why we're going to do that is because it's really a growing area of compliance concern. So hopefully you'll enjoy today's topic. I really enjoy presenting these webinars to our clients and colleagues.
Okay, thank you, Chuck. That takes us to our first polling question. Do you have GST, HST, or sales tax compliance obligations in Canada in 2012? Well, as those are rolling in, it looks like about a third are answering considerably and are answering somewhat.
Well, it's good to know we have a nice sort of mix out there in the audience. Some people with current substantial obligations in Canada, and I'm sure this information will be timely, especially since we're approaching the April 1st deadline, and some also people in the audience that may be new to Canada and have this on their radar as an upcoming concern. I guess the presentation starts with me, but soon you'll be hearing from the real experts in the room, which are Joan, Eugene, and Todd. So, at the federal level, Canada imposes what they refer to as a goods service tax, or a GST. And that GST works much like a standard value-added tax, or VAT, which means that it applies over a very wide base, including both goods and services. And an item is taxable, meaning subject to VAT or zero rated. That means that the middlemen along the transaction chain, while they have VAT obligations, they're able to offset their VAT obligations with input credits, with the ultimate VAT being by the final consumer. Conversely, if an item is exempt, then that means that that's where sort of that VAT obligation ends in the supply chain. And when somebody buys an exempt item, the previous person will have that VAT obligation where the transaction was not exempt. Where Canada gets interesting and sort of different from the rest of the world is what happens at the provincial level, because there are different rules depending on the province you're in. So for the real nitty-gritty, I'll turn that over to Joan.
Thank you. Currently at the provincial level in Canada, there are 3 provinces that impose their own level tax. They apply a sales tax which operates, for the most part, similar to a vanilla sales tax scheme that most organizations would see in the U.S. In contrast to federal level tax, it generally applies on consumer, such that along the commercial stream of activity, there's no tax, generally because items are acquired for resale or for some qualifying exempt purpose. The other provinces that impose that vanilla sales tax scheme are Manitoba, Edward Island, and Saskatchewan. And as we'll see later in the discussion, as most of you probably are already aware, Prince Edward Island is changing that structure effective April 1st. Now, there are a host of other provinces that have harmonized their sales tax structure with that of the federal government and apply a blended sales tax rate known most as a harmonized sales tax. That tax scheme currently applies in British Columbia, New Brunswick, Newfoundland, Labrador, Nova Scotia, and Ontario. the federal level tax, the HST applies on the same base of goods and services. And the rules are, as the term implies, harmonized for the most part. As we'll see and discuss a little bit, there are instances where there are point-of-sale rebates available depending on the category of products. For example, there may be a point-of-sale rebate on books. What that means is that the provincial portion of the tax would not apply in those instances. What's also interesting is that even though these provinces are harmonized, their rates are not uniform at all. There's no set threshold for if a province harmonizes, the rates are all uniform, the rules are all uniform. So point being, they're harmonized, but not completely. The other province that's out there that applies a tax is Quebec. Now, Quebec further harmonized their rules with the federal level GST on January 1st. And the tax, for the most part, applies to the same base of goods and services. The other HST provinces, there are no point-of-sale rebates, whereas what Quebec does, in essence, is just classify a certain set of goods as zero rated. For example, there's a zero rating in books and baby items, where the other HST provinces, those types of categories may be classified as being available for a point-of-sale rebate. In addition, what's interesting about Quebec in the fact that it harmonized on the most part with the GST is that the tax remains separate for collecting and reporting purposes. So those of you that may have just gone through that transition, what you may have found is that the Quebec sales tax, commonly known as the QST, still is calculated and reported as a separate line from the federal level GST. And then finally, that brings us to the other provinces out there, Alberta, Nunavut, Northwest Territories, and the Yukon. Those provinces currently do not apply or impose any type of tax, but what we'll see at the end of the discussion, and as we look to what's the future, we'll find that we're hearing chatter of imposition tax in one of those provinces. Also, we'll find and discover some of those provinces, although they don't impose taxes per se, they impose fees, eco fees on the products that are dispersed in their location.
The next slide is an overview of the different tax types and rates applicable in the provinces in Canada. And please note that there are some particulars about BC, Prince Edward Island, and Quebec. For BC, it is expected to deharmonize on April 1st this year, which means they will eliminate the current HST and will return to the provincial sales tax. The rates will remain, which means there will be a 5% GST and a 7% PST. As it is now, it has a 12% combined HST rate. However, the provincial level tax rules will change significantly for BC. One notable change would be the taxability of services. For example, under the current HST regime, most services are subject to tax, while BC returns to PST, most services will be exempt from the provincial 7% PST. Contrary to BC, Prince Edward Island would harmonize its provincial sales tax with the GST and become a HST province on April 1st this year. Currently, under PST system, Prince Edward Island includes GST in its tax base for the PST. That tax-on-tax rule will also go away once it harmonizes. Joan has mentioned some special rules for Quebec. Quebec further harmonized with GST on January 1st, but the province still administers GST and QSTs. That's not like the typical HST provinces where HST is administered by the Canada Revenue Agency.
Interesting, Eugene. And then also, and just in quickly looking at this chart, as mentioned, you look at those HST provinces, you see Nova Scotia, Newfoundland, Labrador, Ontario, British Columbia currently still harmonized. You see that the rates, even though they're quote-unquote HST provinces, their rates are different, and their point-of-sale rebate rules are different. And get into a little bit more detailed discussion about this tax functionality and how it previously worked and the implications or the changes that took effect for Quebec on January 1 and are taking effect for Prince Edward Island on April 1st. Now I'm going to over quickly to Chuck and Todd. Just kind of a high-level discussion about why we support these rules in Canada and the system options that we have out there for our current clients or for future clients.
Sure. So, with respect to Canada, are primarily two calculation engines that TaxWare supports that can address Canada functionality. And at the outset, it's important to note that we have clients using both systems for transactions in Canada, and they'll be able to continue that process both pre and post harmonization and deharmonization effective April 1st. So the sales use system, which is our HST product, it's been around for quite a long time. It was designed based upon a U.S. tax framework, but has supported Canada more years than I've been here, and I've been here 10 years now. And the way it does, it supports Canada almost as a state, and it treats the provinces as sub-jurisdictions or cities of that state. But nonetheless, it does work, and it works great, and clients are happy in SUT for Canada. And the other thing, let's get the abbreviations out of the way. So we use that term SUT, that's shorthand for the sales use system, and TWE for TaxWare Enterprise. And TaxWare Enterprise also supports Canada. It's a global engine by design, meaning it's designed to support the entirety of the indirect tax around the world. And because of that, Canada is treated as a country with sub-Js or provinces being all the applicable provinces, and it supports Canada in a more traditional way. Certainly, for clients in Canada, calling Canada a country is more friendly than calling it a state. Now, with respect to our TaxWare Enterprise users, we have, based on their ERP, their accounting system, the kind of different needs with respect to how the report out the tax in the existing harmonized provinces. The rule under the law is that the tax should be reported out as a combined single HST, and there are clients that need their tax engine to output an HST that includes both the federal and provincial components of that rate, and we do that in TaxWare Enterprise. But there are also clients who require that the tax engine produce a separate federal and provincial rate, and then their ERP system or their accounting system combines those two rates together, and we support that as well. So, what the takeaway is whatever favor you need Canada to be in, we're able to produce that in TaxWare Enterprise.
That brings us now to just more of an in-depth discussion on those differences in these HST provinces. One of the key issues to know doing business, or if you're new or look to do business in Canada, with respect to registration, if you're engaged in commercial activity in Canada, you're registering to collect the GST, then to the extent you're registered to collect the GST, you're just automatically registered to collect the HST. That's a general rule of thumb with respect to those true HST provinces. Now, with respect to Quebec, even harmonized on January 1, it is an issue to be aware of to the extent you're new to doing business in the country, that unlike the other HST provinces, your NIST issues remain separate. So to the extent you're engaged in commercial activity in Canada and you register for GST, you're not automatically registered for QST. It's a separate test. What you need to be aware of is that both the administration rules with respect to Quebec are administered, both the GST and the QST are administered by Quebec Revenue Quebec when you're engaged in activity in that province. So to the extent, looking forward, if for example, an audit issue were to arise and your commercial activity is limited to Quebec, if you're audited for the federal purpose in the Quebec province, you better cross your T's and dot your I's to ensure that you've registered properly for QST, because the administration will be conducted by Revenue Quebec. The other interesting issue to note out there is when they converted it, the province increased their rate. Prior to January 1, Quebec imposed the provincial level sales tax and included in their tax base the federal level GST. So by including the federal tax in the provincial level tax base, it created what's known to many as a tax-on-tax effect. A harmonization, that tax-on-tax functionality or rule went away, but what the province did was they increased the rate so that to many it became a revenue-neutral change. Because by taking away the tax-on-tax and increasing the rate, effectively the rate remained the same.
So we actually had, and maybe Todd, you've heard some of these as well, I received a number of questions from existing clients about that rate in Quebec that extends out beyond the traditional 2 digits after the decimal point, but goes out to that third digit. And their question was whether our systems can support a rate that has 3 digits beyond the decimal. And we did confirm that, yes, that's absolutely no problem. As a matter of fact, in the U.S., there are local rates that report out to 3 digits, and that's standard bread and butter functionality for us.
That's Chuck. Sorry, let me just interject here, but with respect to rounding, though, you're rounding under 5-4 rounding principles, in that the rate may be 9.975 for the provincial portion, but you're still rounding up based on 5-4 rounding rules.
That's true.
So Joan, you mentioned rounding. Now, I read somewhere in more than a couple places that even though there are special rounding rules that apply, I want to understand, Canada is essentially eliminating the penny. So how does that work with respect to rounding, and if you can't provide change in pennies?
That's an interesting point. In fact, on or after February 4th, the Canadian Mint will no longer be distributing pennies. So on or after that date, Canada Revenue is encouraging businesses to begin rounding cash transactions based on 5-4 rounding rules, in the set, if, for example, you have a transaction at a 0.2, you would round that transaction down. With $1.03, you would round that transaction up to 1.05. With respect to calculation of tax and reporting, it's really non-issue, because it doesn't, the rounding for, well, a couple of points here. One, the issue only applies to cash transactions. So the phasing out of the penny doesn't impact the calculation of the GST-HST. It doesn't impact the calculation of input tax credits on the federal side. But a point we'd like to point out to the list today is that although it may have not much of a consequence on the calculation side for the GST-HST, what you need to be aware of and what you may need to look at is your account methods that you have out there, because something to be aware of is it will impact, although it will be de minimis, but it will impact your reporting for income tax perspective to the extent that the amount gained, lost on each cash transaction due to rounding, to the extent it's gained, it constitutes income for the year in which it's earned. Sorry, just to interject that point because it's pretty interesting. But also to be aware of, it's a non-issue to the extent all your transactions are credit-based, cash-based.
Okay, I think that takes us to our next polling question. Are you carrying on business in British Columbia or Prince Edward Island? Okay, looks like we have probably that are answering somewhat, and even between not at all and considerably. Is that what you expected?
Well, I think that's pretty much what we expected, and it's again, that's a good mix for our audience. That those of you that are currently engaged in transactions in BC and PI, our end result is that we hope that the functionality we're able to provide makes that transition a little easier for you. And for those of you that are not currently there, and perhaps you're here because you plan to be there, we'll come away with an understanding about how our system calculates tax in these locations.
Okay. Next slide.
Joan just mentioned that Quebec further harmonized with GST, but it's still separation between the GST and the QST. So unlike Quebec, Prince Edward Island will harmonize with the GST and become the HST province, just like the other additional HST provinces such as Nova Scotia, New Brunswick, Ontario, and Newfoundland. So PA will apply a single combined rate of 14%. That's different from Quebec, where the GST and the QST rates are still separate. And it's also a reduction from its current PST rate of 10%. The provincial portion of the HST will be 9%. So also considering that currently under PST, Prince Edward Island applies tax on tax rule, which means GST is included in the tax base for PST, then the effective reduction of the tax rate from its current PST system will be about 1.5% when it harmonizes. And also like Quebec, the administration of HST for Prince Edward Island will be by Canada Revenue Agency rather than the provincial government. And so instead of the upfront zero rating of designated products as in Quebec, Prince Edward Island will follow other HST provinces and adopt point-of-sale rebates to certain products, for example, children's clothing and books.
So on, April 1, Prince Edward Island, the regulation will likely apply to the extent those transactions in the province are subject to HST, then you'll be collecting and remitting the HST in the province.
So
that brings us. Sorry.
I had a question for Todd.
Mm-hmm.
Now I know this is a couple of times, and it sort of relates to our systems and how we treat Canada differently. Mm-hmm. For the sales use system, the logic in our system is hard-coded, and on occasion, when rules change, upgrades are needed. So when Quebec changed their rule and eliminated that tax on tax effect, if I remember right, clients had to upgrade to the latest version of whatever language they're on the sales use system. Now we're getting rid of the tax on tax effect in Prince Edward Island as the harmonized. Is there going to be an additional upgrade needed, or are clients pretty much set?
No, the last upgrade included all of these that we've been talking about. There's no changes. Anything else is content related, but the changes have all been done.
So we have the versions of what clients would need to be on?
You know, I have some of them, but not all of them. 3514 is COBOL, 369, I believe, is C, and 3513 is PL SQL.
Thanks. That was probably a little too much to ask. If any clients are on the system right now, the SalesView system, and they have a question about that, feel free to contact the support team and we'll get you an answer.
The bigger issue to be aware of, if you're operating on the SalesView system, is that to the extent you may not have upgraded for the Quebec change, you definitely need to operate an update for the Prince Edward Island change, because our tech support team was to work with folks on the Quebec side, because as noted, the change, the effective rate was revenue neutral. So the effective rate essentially remained the same, whereas because Prince Edward Island is decreasing their rate, the rate is not the same. So tax-on-tax functionality and the rate is changing. So the output will be different, definitely different, pre-HST, post-HST. So here we're going to talk about British Columbia a little bit more. So Prince Edward Island, they will be deharmonizing their rules. As Chuck noted, we were here back in 2010 talking about the harmonization with, choice to harmonize along with Ontario. Come April 1, they'll be reverting back to a provincial sales tax scheme. What's interesting, unlike Prince Edward Island, Columbia is still in the process of refining the rules. Is that not correct, Eugene?
Yes. They passed a provincial sales tax act last year, which is Bill 54, but they are still in the process of completing another bill, which is Bill 2. Bill 2 is going to amend the Provincial Sales Tax Act they passed last year and also provide further transitional rules, so as to complete the re-implementation of PST in BC.
So out there, looking at their websites, looking at on the federal side and or the provincial side, you'll see a lot of the transitional rules, but especially with respect to British Columbia, those rules are being posted, but they're not technically final. So with respect to the Tax for Enterprise engine, we're posting changes with expectation that these changes will in fact take effect April 1st. And changes are out there and available for folks to test with transaction dates on or after April 1. But be aware that there may be some more tweaking to those rules to the extent of the information that's coming out of BC over the next couple of weeks.
And one general principle BC is adopting is that the taxability rule will generally follow the PST rule before the harmonization.
So for the most part, the rules will be the same prior to the rules that took effect in 2010. To the extent you are engaged in activity or you have transactions sourced to British Columbia, it's going to be a little bit of an additional administrative burden in the sense that if you have activity, if you're engaged in commercial activity out there, you have to now go actively register with the province to collect and remit the provincial sales tax. Other issues to be aware of in making the transition is with respect to for customers that are on the call today that are using our systems. If you're using the Tax for Enterprise engine, and as Chuck mentioned, Tax for Enterprise gives you the option to report the HST as one rate or report it as two rates with your ERP blending in the rates together. If you're operating and passing geocodes that return one rate, you obviously need to revert to the geocode that will report the tax as a country-level tax and a state, aka provincial-level tax. So you need to switch or actively go in and switch the geocode sourcing that you're pulling for your transactions in British Columbia. Again, assuming you have access in British Columbia and are collecting and remitting the British Columbia provincial portion of the tax.
That's true. That's another important thing, that once British Columbia deharmonizes the access obligation, so an obligation with Canada won't necessarily mean an obligation with British Columbia. So if clients do have an obligation with British Columbia, they should probably, as best practice, go back into the user interface and check and make sure that their organization has a British Columbia registration number and the box is ticked indicating that they have an obligation there, if they do.
That's correct. And British Columbia, I mean, although the rules, as we mentioned, are fluid and right now, there are registration rules on their website which essentially provide that it makes sales or taxable goods, software, services in the ordinary course of business. You're required to register with the ministry. So, 2 points. One, you're in that the registration is not automatic. Just because you're registered at the federal level doesn't presuppose that you need to be registered with Ministry of Finance in British Columbia. But from a practical perspective, you need to go and check the rules to see whether you are required to register. And keep in mind, if some of you on the call are engaged in business activity in the U.S., keep in mind the rules and the principles are different from U.S. standards in where we see nexus and where you have to have physical presence. Generally, the principles in Canada are more of a broader economic presence. If you're soliciting, although not necessarily in person, but if you're soliciting activity and selling taxable goods into the province, more likely than not, you may need to be registered in the province. Taking this over to our next, making the transition. I apologize if we're repeating ourselves, but we're just trying to hone in on a couple of key points to be aware of in preparing yourself to make the transition, not necessarily to harmonize, but also the transition to deharmonize. With respect to British Columbia, the application of the rates that apply, British Columbia seems to have it somewhat more simple than Prince Edward Island's change, in that the rules that will apply, generally speaking, will follow the invoice date. To rule specifically, the just transitional rules is if tax becomes payable after March 31st, but it hasn't been paid before April 1st, or paid after March 31st, having become payable before April 1st, then the 12% rate will apply. With respect to the provincial portion, that basically the point I'm trying to make is that British Columbia is, for the most part, will follow the invoice date. So if it becomes payable after April 1st, instead of the 12% HST applying, the 5-cent GST will apply. In contrast, if you can take us to the next slide, in contrast with moving on to the next slide.
We're two slides ahead, so drop down 2 slides.
Slide 19.
There you go.
In contrast with Prince Edward Island, it's a little bit more complicated with respect to the transition. The transition generally follows the utility if it becomes payable before April 1st, but the goods are delivered before April 1st, then Prince Edward Island will follow more of a possession rule, so that you take possession before April 1st, but you have to pay it till after April 1st. Then though it's not paid or payable till after April 1st, the GST will still apply. Because generally the rule will follow possession, whereas British Columbia will follow invoice date, regardless of possession. Now, that's a high-level general rule. Obviously, the scenarios differ when you're talking about leases, service transactions, and what's user-friendly for those of us, especially for our team and the research group, is Canada and the provinces, for the most part, provide good, clear information. For some of you on the call that may have activity in U.S. jurisdictions, sometimes finding, what rule applies, it can be like looking at a needle in a haystack. So I think the big issue that we want to make is that both the provincial level and the federal level by key publications. Canada Revenue has issued Notice 278 with regard to the transitional rules as they apply in Prince Edward Island. The agency has also issued 270 with regard to the transition in British Columbia. The information provided in those guidelines to general scenarios of sale of TPP, leases, services. There's a little bit of discussion of the tax at the border. And there's also different notices, special notices as they relate to real property. So, as a due diligence, to the extent you're going through this change, you have activity, you have transactions processing, it's highly helpful. It's highly helpful to review the information provided by Canada Revenue or reach out to the province to read the transitional rules as they apply to your specific business scenario. And the other final point I want to make with respect to the transition is those that are doing business in a cross-border scenario. Shipping goods across the border, as most of you know, need to pay or are responsible for emitting the Division 3 GST, which parallels the Division 2 GST, which is the goods and tax, or the GST, HST that applies that you would see in a retail sector. So the goods at the border, as most of you are aware, you only have to remit a GST, not the provincial portion of the HST, when clearing commercial goods. With respect to regular goods, so if I'm in Prince Island and I'm ordering my new fancy pair of boots to good at the border, you need to now remit the HST to get those goods across at the border. So, remembering back to the beginning of our discussion, those provinces that are sales tax provinces, that whole separate tax scheme, and they follow general vanilla sales tax principles. And whether or not, if you're registered in those provinces, you would need to collect and remit to the provinces, but you would not necessarily need to pay sales tax that may be due to clear the goods at the border.
Thank you, Joan. That was an incredible amount of detail. That's super helpful. So it's advancing to the. Oh, that's right. We're exactly the right slide. So, just in terms of listening to the volume of information we're presenting today, it's clear that this process of harmonization and deharmonization is more intensive for business doing business in Canada on an everyday basis. And it was, truth be told, a lot of work for us, and it's something that we've been working on here for several months, ready for April 1st. And we like to think that some of the work we do here for our clients makes it a little easier for them on the implementation side. But I think one of the things that we've tried to do, and we did this back in 2010 and we're doing it now, is that we're trying to provide as much advanced content as we can so clients can go in and test some of these things. So, for example, in the sales use system, adjusted with a future effective date the the Prince Allen tax-on-tax effect, so it's updated, and we've adjusted some of that rounding functionality that Joan has talked about. The one thing that we can't do in the sales use system is we can't yet adjust all the product taxability rules because of issues of date sensitivity. We wouldn't want clients to produce taxability results before that was appropriate. So that's kind of been, on hold until such time as the April 1st rolls around. So, but for tax for enterprise, we have a little bit more ability to do some things in advance. So we've adjusted that tax on tax. We've adjusted a substantial number of product taxability rules already. We've adjusted the place of supply rules. So effective April 1st, that combined BC geocode that shouldn't be used anymore will produce results to the shouldn't. And there are things that we will have to do for tax for enterprise in the future, but just prior to April 1st. But really, the key takeaway here is clients want to start testing what's going on in the system. Now, with TWE or an SUT user, you can do some of that advanced testing.
Yeah, use some of the advanced testing on the tax for enterprise engine. SUT is a little bit more restricted in the sense that if you're actually testing taxability of product code content, you just need to be aware of that. I'll go over to the next slide, which just brings us to
the following question. So the following question is, how do you assess your business readiness for the upcoming tax changes in Canada? Let's see, the answers are rolling in. The majority, about 5% are saying somewhat ready.
That's kind of what I expected. It's a major obligation, and of course it isn't quite official yet in British Columbia, although from what we're hearing, it's definitely going to happen.
Takes us to the next slide.
Okay, this is Joni again, and we're just, because of the volume of information, we've tried to provide you a very high-level summary of the information, so it's somewhat helpful. So we discussed in those HST provinces, there are products that are qualified for a point-of-sale rebate. What that means is essentially they're zero rated at the register for the provincial portion of the tax. And the category of products, there are rules that apply for books, children's items, feminine products, newspapers, food and beverages, and motor fuels. And then you will see the provinces that are listed. As you understand, those rules are going away in British Columbia come April 1st. But more likely than not, to the extent those products are, for example, zero rated in BC, they're reverting, are they not, Eugene, reverting to an exemption?
Yes.
That's for the provincial portion of the tax as it takes effect April 1.
Yeah, that's correct. And also, it's really like when the goods are exempt under PST, if they become HST, like in Prince Edward Island, it will enjoy a point-of-sale rebate, such as books and children's clothing in Prince Edward Island.
That brings us to slide 23, and reporting, and this is a little bit redundant of what we discussed earlier, in the sense that for HST provinces, if you're registered for GST, then you're automatically registered for HST. Those, if you're a non-resident, if you carry on business in Canada, not deemed to be a small supplier, then more likely than not, you're obligated to be registered to the extent you have taxable sales of goods and services. Differ with respect to exempt supply. With respect to Quebec, to carry commercial activity on in Quebec, you must register for the QST separately, and you must register also for the ST. Now, as Chuck mentioned at the beginning, the GHST and QST is really similar to a VAT-based tax. So the tax applies along the stream. To the extent it applies along the stream, you're entitled to claim back income tax credits, or in Quebec, it's input tax refunds for that applies on the goods consumed in the commercial activity. Now I'm just over to recycling programs that we're seeing that have taken effect in Canada.
So if you sell goods in Canada, one thing you want to know is the transaction not only would be subject to taxes, it might also be subject to fees. Provincial governments implemented recycling programs, generally called stewardship organizations. They are industry-led, not-for-profit. And those programs administer recycling of designated products, and they are funded by fees. And those fees are per unit, per product, fees usually imposed at point of sale. Even if they are not imposed at a point of sale, still they can be passed along through the supply chain to the end consumer. So in almost most provinces that impose fees, the end consumer ultimately bears the burden of the fees. For example, in British Columbia, has the most stewardship programs amongst all the provinces. For example, lighting products, electronics, small appliances, and outdoor power equipment. So if you are selling those products, you probably would be subject to fees, that charge fees on the invoice. Also, Manitoba has a number of new stewardship programs in 2012, including the electronic waste fee program. Another notable information is that Ontario substantially changed their fee amount for electronics effective January 1st, 2013. So almost every category of products, the fee amount has been changed in Ontario.
So that's us over. Thanks, Eugene. That jumps us over to our next polling question.
Yep. Did you sell or plan on selling into Canada items under any of the following product categories: computers, electronics, light products, tires, paint, or motorized equipment? Like so far, we have about a quarter, 25% or more are answering not at all.
So we'll move through the rest of the presentation on point of sale fees relatively quickly, and we'll get on to the future of Canada in general.
Right. So, and to the extent, really from a high level perspective, if your business activities, if you're just starting to think of growing your business in the Canadian market, what's interesting to know and to be aware of is if you're selling any of these categories of products, ones noted in the table presented, if you're selling tires, electronic products, paint, small appliances, lights, bottles, there are fee programs in all of the provinces that are checked off. In addition, there are special invoicing rules that may apply. Quebec has special invoicing rules. So to the extent that you don't want to share the burden of that fee expense and want to pass it on to your end consumer, in some provinces there may be special invoicing rules for you to be able to do so. In addition, you need to know that there are more products to consider, such as on oil and paper and packaging materials, but we've listed the broad base of fee programs that currently exist. Key points to know: they're not necessarily administered by, these programs are generally administered by a stewardship organization, which is industry-led, except I think there's some special rules in Prince Edward Island on the tire fee program. You need to be engaged in industry and reach out to those stewardships, since information relating to those programs may not necessarily be listed or included in the ministry websites, either Canada Revenue or any of the provinces. And that jumps us over to what's the future hold. And just quickly summarizing, just the chatter that we're hearing out there, given that British Columbia deharmonized, Rhode Island has harmonized, there's rumors floating around whether Alberta is considering adopting an HST to budget shortfalls that they may be having. With respect to the other provinces, the other holdouts would be Saskatchewan and Manitoba. I mean, the conversations are always fluid. It's questionable, but the activity or the discussion about whether Alberta will be harmonizing is something that the research team is constantly monitoring. Todd, you can tell, on the sales use system, we sort those fees and fee data. That's a flat file, is it not?
It is.
Right, and then on the Tax for Enterprise engine, reported directly associated with related product codes. Those fee programs seem to be changing all the time, especially in British Columbia, which is, moving away from the harmonized system and seems to be imposing these eco fees on those products sold into the province. Now, I think that wraps it up for today, right, Eugene, Chuck, Todd?
No, we do have a lot of questions, so maybe we'll get to some of them, and those we can't get to, we'll respond subsequently, especially those ones that are technical in nature. Now, Todd is here. Todd is an incredible resource, and he'll help greatly with that.
First of all, thank you to our panelist speakers today, Chuck Maniaci, Joan Howard, Eugene Wang, and Todd Nelson. And secondly, before we move to our Q&A segment of today's program, we'll play some music for about 30 seconds to give you a chance to submit your questions. To do so, type your question into the Q&A panel located in the lower right-hand corner of your screen. Then click the send button to enter your question into the queue. We'll be right back. Okay, we have quite a few questions, so Chuck, I'll throw it over to you.
Okay, this is the first question here, and it asks, if somebody is registered with Revenue Canada for GST, are essentially registered in every province that has HST, so the harmonized provinces, regardless of whether this individual has individually notified those particular provinces. So what's the registration obligation in the particular harmonized provinces?
For and reporting purposes, if you're registered for GST, you're registered for HST. Just it becomes a transition issue depending on the type of supply, whether it's goods, whether it's services, whether it's leases. So generally, if you're registered for GST, you're automatically registered for HST. Again, except in Quebec, even though Quebec is, quote unquote harmonized, they're a little bit not, in the sense that the registration is not automatic in Quebec, and the collection and reporting remains separate and remitted to the GST. Quebec administers the GST and the QST for transactions sourced to Quebec.
Excellent.
So if that's not clear, or if there's a follow-up to that, please just shoot us another question and we can respond, outside the seminar.
So Todd, this is a question for you, and this is from a user of the Sales and Use Tax engine, and wants to know whether they have, aside from applying the content updates as they are available, is there anything that they need to do on their side with respect to preparing for harmonization and deharmonization?
If they're on the latest versions.
And that's important, right?
That's what's important, right? They need to be on the latest versions of their respective system.
I think we deliver, aside from, once you're on the latest version, everything else that's happening is handled through content, right, Joan?
That's correct. Any rounding issues, because rounding on a 13%, a 5/8 blended rate is obviously, in relation to British Columbia, the rounding for the tax will be separate. To the extent you've enabled Nexus in British Columbia, the rounding will be per tax level. So 5% GST will be rounded separate, 7% PST. But as Todd knows, the key is to make sure you're on the most current version of which system you're operating on.
I mean, one caveat, if you're on a fairly recent version of the COBOL system, we might be able to make some adjustments to that.
Absent upgrading.
As opposed to upgrading.
Right.
I mean, right, but it has to be a fairly recent one, probably 3.5 and above. But I still, can't emphasize enough that you should be on the most recent version.
So,
If possible.
as a follow-up to that, any tips for clients on SUT users that want to run some advanced tests? Is there anything that should be aware of just to make sure that they're compliant for British Columbia and Prince Edward Island, aside from what we already talked about regarding taxability rules not being there yet because of date sensitivity issues?
Well, what we've talked about in terms of the changes in the various provincial rules, they can simply run a different transaction date. That's all. They can test it.
Flip that some to April 1st, and the new rules, to the extent they're available, will start to appear.
Sure.
Great.
I think that's all the time we're going to have for questions today. I do want to thank again our presenters, Chuck, Joan, Eugene, and Todd. We'll email those questions we did not get a chance to answer to those people separately. And thank you also to our listeners for joining us today. For additional information on any of the tax or products or services referenced during today's webinar, you can call 866-863-3904 or visit taxra.com. And for a complete listing of Taxra webinars and recordings, you can visit taxra.com events. Be sure to join us for our next webinar, scheduled for Wednesday, March 27th, focusing on taxation of remote commerce. The rules are changing. Are you ready? Finally, you can follow us on Facebook, LinkedIn, and Twitter. Remember to provide us with feedback before you log off by completing the survey on the next slide. As I said before, this is a requirement to receive CPE credit, and we do appreciate your input as we plan future webinars focused on sales, use, and VAT solutions. That concludes our program for today. Thank you for joining us.
Thank you, everyone.
Thank you.